folks. Hope you're doing well. If you would be so kind, if you can hear me, I'm not sure you can. If you can hear me, let me know on Twitter. Just tweet at me and say, "We hear you, old man." 5x5 will be sufficient as well. Can you hear me? All right, Chris, thank you so much. Let's see if I can get a couple more people just to confirm it. Thank you, Jasmine. Eduardo, thank you. All right, so we are looking at the NASDAQ here. Um, Give me a moment. I apologize. Just want to make sure I mention the right report that's coming out. At 10 a.m., we have the revised consumer sentiment data. So it's a medium impact driver. This morning, we had core durable goods orders, and that gave us a little bit of a pre-market rally back up into new week opening gap, and then it went a little bit higher than that, obviously. Now, I want to take you over to a 15-minute chart real quick, and I'll let you see what I'm looking for. I mentioned the other day on Twitter, or they call it X now, we had this big drop down here on Wednesday. So Thursday, I tried to kind of calibrate your attention and focus on looking at the relative equal highs. We have relative equal highs here. We just cleared those. We have these two here and this one here. So I like the idea of getting up to 680. It may use the data at 10 o'clock to go through that. We've been fighting the impulsive nature that most traders want to pick the tops in bull markets. I know I tried to do that. Not technically. I was afraid that a high was forming when I first started trading, and that would usually keep me from taking trades when I was first starting out, thinking it couldn't go any higher. It's at all-time highs. It can't go any higher, and it just kept going higher. So because it's the next election year, and because it is a year that oh my goodness, what am I doing? I'm supposed to hide that kind of stuff. I'm supposed to be paper trading. There goes my reputation. All right, so we're looking for reasons to see the price go higher. And because it's an election year, they're going to pump up and froth up the stock market, because the public's perspective is that the stock market equates to the economy, and that is not a true statement. Okay, it's a big casino. We're all in here doing things, that has absolutely no bearing on what the outcome is going to be for our economy. The stock market can keep going up. Just look at Venezuela. Years and years ago, it used to be the richest country in South America, and lavish, and their stock market kept going up while they were going down in hyperinflation. So we're probably going to see the same stuff here. I mentioned that in 2016, the United States is heading to Venezuela 2.0. Just look around, you see it. So, and what we're watching for is what we get at 10 o'clock. Okay, so the first 5 or 10 minutes, worst case scenario, 15 minutes, we'll see what we get in regards to price delivery. I would not want to take a silver bullet trade, Cameron's model. I would not want to take that until after a few minutes, the 10 o'clock medium impact news driver, because they use these types of data points to mask or smoke screen their real intentions, and it's usually perceived as, well, this is what the market does. The market uses buying and selling pressure, and it's really not that. But we'll be studying these two price levels here, and again, I'll go back and take a look at the tweets I posted yesterday, telling you to keep your focus on the things that were smooth and left remaining above the marketplace after we had Thursday's decline. So, admittedly, I was working with my private group yesterday. I'm going to jawbone a little bit until we get to 10 o'clock, because there's really nothing for me to talk about right now. So I just want to give you a little bit of backstory. Yesterday, I was working with my private mentorship students, and no, you cannot join it, and no, I don't give signals, and no, I don't teach them any special videos or lectures. This is we all hang out, and sometimes I'll call Price, with them live, and I was doing it audibly. That means I was recording my voice and sending those little clips to them real time, and it's a lot easier for me to do that than to just type out in all the individual user groups. So when I do that, there's no recording. Okay. You would have never known yesterday that I took two losing trades had I not made that public. But they were watching me. They heard me explain what I was looking for, and I was using many of the same PD arrays I used yesterday in the mitigation of those two losses. So the first losing trade I took was a $1,200 loss, which was my normal full position size, which isn't much in terms of handle movement against me, but it's still nonetheless it's a loss. And then I took a smaller leverage position because of the loss, and I got burned for $800 on that. So total $2,000 less commissions. So I had to work to get that back. Now I told them, admittedly, I said, for them, because it was a morning session after a large range day on the daily chart. Let's take a quick look at that daily chart real quick. You know the protocol. If you're very, very new in trading, you want to try to stay away from the morning session after a large range day. And I get the question a lot as to what constitutes a large range day. How do we like determine what that is? What is it measured against? What makes it a large range day versus just picking a title and just applying it to that? Well, if you look at what we've had. Let me get this off here. It's a lot of lines and stuff. Here's Thursday. Here's today's Friday's trading. And Thursday, look how much larger this is in relationship to the last several days. Okay. I like the last 3 days, and it's usually a repeating theme in my concepts. Whatever the range average is over the last 3 days, if it's larger than that, then we're outside of the normal 3-day range. Now, you can have a large expansion day inside those last 3 days, and it may skew the data. But over time, when you start to see the 3-day average start to compress and go smaller and smaller and smaller, I got this idea so that way for the folks that like to try to say I rebranded something or took somebody else's stuff and applied a new name to it, and that's really not what's going on. But everybody else is doing that with my stuff. I bought a book in 1995. It was called Street Smarts by Linda Rasch and Larry Connors. And they talked a lot about what Toby Crable mentioned in his day trading book. And it has to do with the smallest range in the last 7 days. Okay. So I got really interested in that idea of looking for some compression where the market starts to get smaller and smaller and smaller. And when the market gets really, really quiet, I wasn't able to observe this until I heard Larry Williams describe it in one of his keynote speaking ventures where he talked about short-term trading and day trading. And one of the things that is a precursor to large ranges is an inside day. Okay, an inside day is what we have here. So here's Thursday's trading. And I want you to take a look at what I mean by that. We have, don't worry, I have time. You're looking at the clock. You're going to start talking, it's going to move, and you're going to say, well, there it is. You missed me, haven't you? I know you have. I know you have. The old man knows. All right, so here's Thursday's range. But now notice also Thursday's range is inside of Wednesday's range, which is here. Now this is not my uh, this is not my work. This is something that I learned from Toby Crable and Linda Rasch and Larry Connor's book, and the ideas were further helpful to me when I applied what Larry Williams was talking about, specifically range contraction. And the idea of looking for the market to get into these small little ranges. And I'll take my hoodie off here. It's a little too warm in here. When the ranges get smaller, or if they get relatively smaller than they have been over a predetermined number of days or periods, um, Toby had this idea that the smallest range in the last 7 days usually is a precursor to something. And without stealing the thunder from his book, and you can get it off of Amazon. It's not the original book. I have the original book. It's very, very expensive. You're going to pay a lot of money for it, but you can get like a really poor photocopied edition of it, but you're still going to get the same stuff. So I have both. I have the one that's sold on Amazon, and I have the actual original first print. So you can see we cleared that initial buy side there. But real quick, let me get into here's Wednesday's trading, the high of Wednesday and the low of Wednesday. And then Thursday, we had this smaller little range inside of it. So the low of yesterday on Thursday was higher than Wednesday's low, and the high was lower than the previous day's high. So this is referred to as an inside day. Now, if you look for this type of thing to form, it usually will set off let's put it this way. There's a lot of traders that are using volatility and filtering when the market is more likely to or more prone to create these expansion moves. It doesn't give you direction just because it creates an inside day. You have to have some kind of measure of higher time frame order flow, understanding where the trend is, where it's going to go, or as I teach it, the draw on liquidity. So on Thursday, I talked about how your focus should be on where the things are left smooth. Okay, so relative equal highs. So, but if you want to use how I use it, I look over the last 3 days, and when ranges start to compress below the average of the last 3 days, I I kind of get excited about that because I know I have a large range candidate forming. But after a large range day, I've taught you that you want to try to avoid the morning session. Now, me being ICT and doing ICT things, I like to go out here and share with my students and do things that the average bear can't. Well, the average bear and I were in the same category yesterday. I tried to do something that wasn't able to pan out in my favor for the first 2 times in the morning session. Now, I told my students, I said, now they should sit still and just go home with the L, go home with the drawdown, and just eat it, and then come back the next day and try to recuperate it. But because I'm who I am, and I just I don't like that. Excellence is my destination, and I'm always pursuing it. So I went in, and obviously I mitigated that. So and then came back with a $12,000 day, which I know that kind of stings for Ruse. But the 15-minute time frame, we'll drop back into that real quick. You can see how we had Thursday's drop down, and retail was all over just thinking, okay, we've topped, it's over, the market's going to go in, bears are in control, all that type of rhetoric. And then we had this really, really difficult morning session. We didn't have sustained price runs. There's a lot of give and take back and forth, a lot of scribbling. Okay, imagine your 5-year-old with a crayon for the first time, and they're looking at your budget reviews that you're using for your work presentation, and they color all over top of it. And this is kind of like what it looks like, where it's back and forth, back and forth. It's very, very fuzzy. Okay, this is what I refer to as fuzzy price action. And the only reason why I came up with that term is because I was trying to teach my kids younger, and it just stuck. Okay, so that's my highly technical uh, layman's term. the This high here is a little bit higher than that one, but nonetheless, my focus has been here. And on Thursday, I was prompting you to go back through your charts and look at anything that was relatively smooth in terms of highs. Retail would see that as a classic area to defend any short positions. And I'm quite sure larger funds have positions with stops above that. And we're really getting close to doing that now. We are at the 10 o'clock time. And let's drop into a 1 minute chart. And you can see how we use the consequent encouragement of the new week opening gap right there perfectly. You probably would have never known that was likely to occur if this guy on the internet did come out and talk about it. So here's our run on those buy stops. Okay, and now we'll sit and wait for a few minutes and see what it wants to do. Now we have a huge gap. So if you look at the regular trading hours, right here, this is beautiful. That's my favorite type of range amount for looking for gap ideas. But because we have Friday, that's the trading day of the week, because we have had a disruption on Wednesday where it traded and made the low of the week, and then we had Thursday inside day, then we have what? We have a candidate for Friday being a large range day, with my prompting on Thursday saying that your focus shouldn't be on going lower because we already had the sell-off. Retail's already expecting all that. So they're going to use Friday to do their run on unfinished business. Unfinished business is the orders up above the 659 and a quarter and the higher level that I can't see because this candlestick, um, what is that? 680. Okay, so 680 level. So that buy side, both levels of buy side have been engaged now. I'm not suggesting or trying to make the case that it would want to come all the way back down into the gap. This is a day where I would say, okay, this is probably going to be a day where we leave the gap intact and not even try to go back to it. It can have a retracement, but because we're in a primary bull market, we're in an election year, and we're just literally less than 2 weeks away from the election, if you believe it. The probabilities of it going back down to that gap, based on what we're seeing here, is not as high as it would be if it were like in this area here. And whenever you have a opening gap like this on a Friday after a large range day, then created a subsequent on Thursday smaller range day, all based on the daily chart, that compression, that small tightening up, it's kind of like a spring. Okay, I'm going to borrow the term actually Larry Williams used. It's kind of like taking a spring, a metal spring, and twisting it tighter and tighter and tighter until you can't compress it anymore. And then when you let go of it and just throw it away, it springs. It's a lot of animation. It doesn't just move a little bit. It's bouncing all over the place and it's moving around a lot. Well, that's what small range days or inside days create. It creates that probability that you're going to get a large range day. Now, a large range day has the benefit of having very repeating characteristics. And I'll show you what I mean by that real quick. And I'm trying to draw a rather crude depiction of what a open high low close bar would look like on a daily chart. Okay, so now imagine we had the Thursday small range on the daily chart, and this is hypothetically a daily candlestick. And then you have Thursday's small range day, and then not to scale, but Wednesday's larger range. Okay, so we have Wednesday's daily candlestick or bar, then Thursday's smaller, which is it's higher low than Wednesday's and lower high than Wednesday's, respectively. And then we have Thursday closing with a small range day, and then Friday we have all this buy side up here that has not been engaged. After Thursday's went lower, smashed everybody's expectation of continuation. Now everybody is tricked into thinking the market's going to go what? Lower. So because we have the probabilities of seeing and I apologize if you hear a noise in the background, like this vibration, my neighbor is having trees cut down. So I had to deal with that yesterday. So in a way, I was kind of glad I couldn't actually live stream. But today, if you hear it, just know that it's something I can't avoid. There's a lot of big trucks out there cutting down rather large trees. So the Friday, large range day, we solved the issue of direction because of my prompting on Thursday telling you to look at where everything is left in your charts where they're smooth, relative equal highs. And I'll cycle through in a lower time frame and show you a couple setups that happened pre-market and overnight and in Asia last night using that same idea. But for Friday, because we're expecting the large range day expansion to occur, the direction is solved by looking where is the market leaving smooth highs or smooth lows. Well, we had Wednesdays drop down. That shift in sentiment, that means retail's looking for lower prices, go back to and revert back to a higher time frame macro perspective, which is it's an election year. So they're going to keep trying to push this monkey higher on the tree. And then what happens after November 5th, who knows? Does it stay higher on another limb or does it fall like a coconut? And then we'll see what we get. But here, the idea is that the large range day will usually occur after the small inside day. Whenever there's a small inside day, it's either the very next day or worst case scenario, the second day after. Well, you can't do that here on Friday because we don't trade on Saturday. So what are they going to do? They're going to rush. They're going to rush right at the opening bell. And you see that happening here. the open is the low of the day thus far. So what are they doing? They're rushing to get the market up here. Who is they? The algorithm. It's just simply running really, really quick to get to that level here because it doesn't want to offer the opportunity for any individuals that have their stops up there that have been holding short, looking for Wednesday's continuation on Thursday, but didn't happen. And then Friday, here it is. They run real quick for them. That sudden one directional run is going after that liquidity. So they can't pull their orders. The direction is going to be bullish, as I indicated on Thursday's tweets. I told you to focus where the market's smooth. And one of the things I learned from Larry Williams is on large range days, if it's bullish, the open is going to be very, very low on the daily range. Okay. And I know that it's going to be in the lower quarter of whatever the daily range would be. So let's do some math on that a little bit, rough math. If we know we're opening at 9:30 and we're going to view this, it's not technically the daily open, but I look at sessions the same way I would look at a daily candlestick. For me, the morning session, the high and the low, where we start and where we stop, I look at it in this perspective. This is power three. So I'm looking for the opening when I'm bullish, and I want to see manipulation. That's the drop down, because if I'm bullish, I want to see some opposing direction. That's the Judas swing. That's manipulation. And then the accumulation below the opening price or just above it, when it comes back down and touch it again, it does not need to come back and touch it. But if it does, that's all part of the accumulation phase. And then you have the profit release portion of the run. Then you go to the target, which would be the liquidity or some higher time frame PD array. That's these two levels here. So the market trades up into them. And again, these levels, this is not to scale, but it's just the idea of Thursday was a small range inside day. And then Friday, bullish. The open's going to be near the low of the day. It's actually the low of the day here if we're looking at the morning session. But if you look at it through the lens of overnight and at midnight, there's midnight. It creates the opening here. Look at it like this. There's your opening price. Here's the low of the day right there. So this line right here, think about this crude depiction of a hypothetical daily candlestick, open, high, low, and close bar. That opening price is this. This drop down is this little tail that's making the low of the day. And then the market trades higher. It doesn't always, but it can come back and use that same opening price. What is it doing there? Trading right to that opening price. Hits it. Then it consolidates. What's it doing? It's accumulating. It's accumulating all around that opening price. It creates the first drop down. That's where smart money is going to buy. I spent my first few years trying to decipher this mystery because that was the weakness that Larry Williams admitted at the time. When I was studying everything he ever had, he said that he wished he knew the zip code of all the traders that would knew how to buy below the opening price. Okay, that was like a facetious statement that, he admitted his weakness. So he would always do what? He would be buying some portion of the previous range or an average of average daily range and take 20% of that range and add it to the opening price. And then he'd be buying up here. I tried that and it hurt me. Every time I tried to use that kind of stuff, I lost money. I'm not saying that he has stuff that doesn't work or he didn't make money with it. I'm just saying that because I was not able to be consistently following every time of doing it, I will admit to you that the losses were heavy. And when they hurt, I would be afraid to take the next trade. So I'm not going to shit on him and say his stuff didn't work. I just wasn't able to weather the drawdown that it brought with it. So because he said he couldn't figure out how to be buying below the opening price, I went back to simply saying, okay, well, you have a lot of the points already figured out. Toby Crable, he brought up some things, the narrowing of the range and the narrowest range in the last 7 days when it creates that. he was a breakout artist. He would buy on a breakout above or sell on a breakout below. I was never interested in doing that because that's synonymous with what Larry Williams was doing then when I first started in 1992. So because it hurt me buying with a portion of the last 5 days average daily range and then taking 20% of the average daily range, if I'm bullish or if Larry Williams was bullish, he would add that to that opening price there. Well, he would actually do it here on that opening price. But because I was looking at the daily range and I was trying to figure out how I could facilitate a model that would be buying below the opening price in days that would create this type of scenario, I just went back to time. When does the day start? Midnight. So at midnight, I'm going to look for something that drops down. I don't want to chase that because I don't want to be a short seller. I didn't trust short selling. I didn't know how to do it when I first started. So I just let it drop down. And then when it gave me a bullish divergence on the stochastics, and then I had a histogram on the MACD, that was my filter. Sometimes they didn't agree. Sometimes I missed moves, and then I'd have to chase price back in the 1990s. I was afraid I'd miss that because I would think just like most of you would. You would think, oh, I'm missing the only up close day with a big range when they're going to repeat in the future. But because I was first now fleshing out these ideas into models that I would use and apply with real money, the the fear factor was too large for me to do a lot of things that I'm comfortable now. But the point is when you have a large range day expected, Larry brought a really amazing observation that I didn't notice, and I was looking at charts a lot before him. Not before him, but before getting into his material. I never noticed that the opening would be near the low of bullish days. It was just completely, I didn't know about it. I didn't pay attention to it. It never drew my attention to it. No one ever called any special attention to it. But because his material talked about that, I was like, wow, as a day trader, like that's a superpower. Like that's literally like one of the wonderful advantages if you're a short-term trader or a day trader. You want to try to focus in on days when it's likely to start a price run like this, where everything is in your favor that it's going to go one direction, find the opening price at midnight, and then anything below that price as it drops down, if it agrees with other factors that would constitute a trade, then it goes without saying that you have a high probability that you're going to be entering below the opening price, where and when smart money would accumulate their long positions. And just know if we have an economic counter like we had this morning, we had 8:30, two news drivers, and I don't recall off the top of my head what they were. Give me a second. I don't want to say something that wasn't accurate. 8:30, we had core durable goods orders, and again, that's a medium impact news driver. You can find this information on forexfactory.com's calendar or Econo Day, and they're both free resources. But then we had another news driver at 10 o'clock. So we had a split. Notice that? We had 8:30 news, and then we had 10 o'clock news. So you got to be real careful on days that have that split news delivery because sometimes it can create like a catapult type move or whiplash where it sends the market one direction, not the data, but the algorithm will use that data and trip traders up, and they'll use the first set of data at 8:30, kind of like a FOMC where the first run is the fake run, and then at 2:30 during the conference at FOMC, the real run takes place, and it's much larger in the opposite direction. Well, sometimes when you have split delivery on the economic calendar, 8:30 and 10 o'clock news like that, it can create those scenarios. But you can filter that out on days and circumstances like today where we had the bias was bullish. I shared that with you yesterday on Twitter. I said keep your eyes on focused on the smooth highs. That's your bias. That's me point. Look up. In other words, don't go short. Look up. And when we're looking for the last trading day of the week to go for that target or these targets that we had outlined here, that means that they're going to use the opening bell. And even though there might be a large gap here, even though that there's a 70% likelihood that it trades the mid gap, these are the circumstances and these are the types of days where it's going to say, not today, not today. So it's in a hurry, it's a rush to get up here and get to that information there. Or not information, but that liquidity. So what I'm suggesting to you is this. If you were aware of these types of things. And I covered a lot of this stuff in mentorship. I taught about it in topical studies before I started doing paid mentorships in 2016. I will never, ever, ever, ever do another paid mentorship. So for the people that are pretending to be me on other social medias, I'm not trying to get you to buy into a new mentorship. I'm never doing that again. I'm officially retired. I'm never doing that. I don't need your money. I'm doing this for free. I don't care. Okay. I don't want to do it anymore. It's too much work. It's a job. I don't want that. So, but you can find all my lecture notes and stuff for my mentorship, and it's the stuff that you'd be paying for if I was doing a mentorship. So why would you want to pay me for something I've already shared publicly? I guess people just want to be part of the crew right now. I'm trained by Fifu Huddleston. Like that means anything. I'm just a guy. So take the crude depiction off here. And if we knew that the 10:30 to 11:30 hour that usually creates the intermediate term higher low of the morning session, and then it invites the lunch macro to define where the order flow is going to be during that 2 hour period between 11 o'clock and 1 o'clock, or specifically 11:30 to 1:30. Okay, so lunch for New York is between 11:30 a.m. Eastern Time to 1:30 p.m. Eastern Time. The way that would unfold here is, let's just say, play devil's advocate for a moment. I'm going to be with you till 10:45. Okay, so that way we know what's going on. But at 10:30, let's say it is 10:30 right now. It's not. We have 11 minutes or so to go. What would happen is it would start computing, computing, computing. I was going to say computating. We'll say that the algorithm will computate the range high and the range low, and then it'll define where midpoint is, or equilibrium, and then below that equilibrium price point at 10:30, then it'll start looking for sell side. And the lunch macro is always going to run on those that are profitable. That's what it does. Okay. That's exactly what it does. So sometimes it'll go down and just take the first pool of liquidity, and then it'll consolidate in the rest of the day and go no lower and make no new high. Other instances where it'll trade down, trade into the trailed stop losses, and then once it triggers that sell side, then it'll accumulate and start running higher and keep going in the rest of the day into the last portion of the day and close the week out strong on its high. I believe that that is likely to occur today, meaning that if we stop, say you were a session trader, there's nothing wrong with you being done for the day if you were already long and you've traded up to here, or if you took profits early and you weren't able to see this, or weren't aware of it. If you are in a flat position right now, you're not in the trades anymore, you're flat, or you haven't taken a trade, this is a wonderful instance where you can sit still and say, you know what, I'm content for this week, I'm done. Now, everybody else out there with courses to sell and signal services, they're going to say, oh, well, so ICT said, look, he said he's done trading, but they're going to show you 20 other trades the rest of the day, filter out the times they didn't work, where they didn't make money, and they're going to show you the combines or the funded accounts that made them money that day. Okay. I'm being transparent. I'm being honest. I'm telling you. Okay. You didn't know that I took two losing trades yesterday. Unless you were a part of my group, you never would have known that. But because I said if I had them, I will tell you about them. They weren't recorded, but they were outlined audibly, just like I'm talking right now. I didn't put any kind of charts up and point to anything. I just said, okay, watch this 1 minute candlestick at 10:54. Watch this fair value gap. I want to see this become an inversion fair value gap. And the first time I used it, it slipped through it. And I was like, okay, well, I got burned on that one. So because I'm staying with the idea that I shared with you all on Thursday, that start looking for smooth highs. That means my bias is bullish. It's been bullish. So I'm not going to abandon that narrative. I'm going to sit still and wait. When the market starts to shift in my favor again, wonderful. I'm going to use those same PD arrays. They're not stale. Okay, I don't trade supply and demand. Okay, we don't always look at the first run into a zone. I don't trade zones. It's bullshit. I'm looking for PD arrays that the algorithm's going to go right back to. And you watched me execute on those things yesterday. You know, I used a 5-second chart just to twist a knife on some guy that works on a campus as a police officer. Well, potentially as a police officer, let's say it that way. So buying near the low when it's bullish and it's a large range day, okay? It affords you a lot of comfort, patience. Now, it doesn't mean you're going to have patience in the beginning because it's going to be easy for you to want, like if you were long, let's go into regular trading, or now let's go on electronic trading hours. Let's go back into that midnight time. And here is midnight rate. What the hell am I doing? Right there. So at that point, at midnight on Friday, we're looking at what? The market consolidating. It's part of a larger consolidation, but it's during a period of time when the market's likely to do what? Rally higher, move higher, trade higher. So if we're looking for that range expansion, that big explosive price run that's occurring because Thursday was an inside day, our bias is determined bullish. We're expecting two uh, news drivers at 8:30 and at 10 o'clock. So we have split delivery on the calendar. So normally that would create a back and forth, and then after the final 10 o'clock news is released, then the real price runs for the daily candlestick range is delivered. Not today because it's the last trading day of the week. We have unfinished business up here to draw on that liquidity. So by looking at that at midnight, opening price, drop down, it trades back above it, trades back down into the opening price here, rallies, accumulates, accumulates. 3 a.m. What time is 3 a.m.? That's the heart of the London session. So we would what? Expect the market to do what? Create some kind of a displacement. Does it rally higher? Yes. Does it go above a short-term high? Yes. Then the market drops back down. What is it trading back down into? An order block. Does it take the low out? No. Does it rally again? Yes. Volume imbalance, inefficiency, inversion, fair value gap. All of that's being clustered all in that same area right there. Consolidation, consolidation. And then finally, at 3:30, rips, trades higher, takes higher, runs higher to 4 o'clock in the morning, trades all the way back down into the middle of the consolidation in here. What's the bias? What are we looking for? Higher prices. So anytime the market trades back down into a discount, PD array, mid-range or equilibrium like we see here, years and years ago in 2012, 2013, 2014, I was doing just topical studies where I would talk about things that were just very germane to one principle, one little thing. And they were like my little breadcrumbs to see if I can accumulate some kind of an interest in people wanting to learn what it is I was trying to share. And they were very popular back then. And I don't have them on my channel anymore. And I've already taken down a couple other YouTube channels that have put them up because they're trying to monetize my stuff. You don't have my permission, and about 3 other channels are about to come down tonight too, because they're taking my mentorship videos that I'm doing here and my live streams, and they're putting them in their local language. I do not give you permission to do that, so you're going to get a wave of copyright strikes, and you're done. And I don't take them back, so don't ask me in an email. And you can send me all the nasty grams you want. Ain't going to change it. But all those things that I did topical studies, they're all wrapped up in the things in the lectures. It's all built in anyway. So if you're really trying to learn and study, you're going to see all that stuff. But if you're looking at how price delivers continuously higher, and then at 7 o'clock in the morning, we have the AM session starting. So what do we have here? Smooth highs. So what's resting above that? Buy side. Market rallies up, trades up to and through the buy side, and then comes back down into this inefficiency here. If it's two inefficiencies, think about what I taught for model 2022. This is the one you want to try to trade in, but your stop has to respect the second fair value gap. So you can see it drops down into it here, but then still goes higher. Volume balance plus buy side balance, sell side efficiency. That's a nice PD array confluation. Confluation. I'm making my own words up here today. Uh, confluence in agreement to two PD arrays and a discount. Trades down to here, rallies once more. And then this is 15-second. I was defining the range there, which I have to go out to do that here. 15-second. All right, let's just say that you wanted to be a part of this move, okay, and you wanted to be a part of it over the daily range. But you know, as I'm teaching in this lecture, because of the circumstances and the things that are germane to today, being Friday, last trading day of the week, unfinished business, that big pool of liquidity above on the 15-minute time frame, these price levels up here, all the way up here. Because that is the likely draw, my private students, I know this sounds terrible to say it, but I'm giving them a nod in the lecture, in the live stream, because they know that we were looking at these levels. We weren't looking at them just yesterday for a target for yesterday, but we've been looking at them. So it finally delivered this morning. But because we know that the likelihood of a large range day is going to form today on Friday, because we had a small inside day on Thursday, meaning that the range on Thursday's daily high and low was smaller. The high was lower than Wednesday's high, and the low of Thursday was higher than Wednesday's low. So that means it's inside of the previous day's range. Whenever that occurs, you have the indication that there's going to be a large range, explosive, large range, one directional move. When it happens, it's going to most likely deliver in the basis of a low resistance liquidity run condition. That means it's not going to be a lot of fuzzy price action. Not going to be like it was yesterday on Thursday. Think about what Thursday really did. It created a small inside day relative to Wednesday's daily high and low. And because it's creating that small range day, it's not surprising to see how it was very back and forth. Even though it was tradable and I got beat up on the first two trades I tried, the next two fixed it because I stayed with my narrative. I didn't throw it out, throw the baby out with the bathwater. I didn't abandon my model because I had two losing trades in front of my students. I didn't lose my edge. They didn't change the algorithm. All these things that you're worrying about. I know that I have models and a perception of a price that's going to stick to me forever as a trader. I'm never going to abandon them. I'm never going to look at the market any other way. But I'm also a realist because I know I'll mess it up. And I did. I messed it up yesterday. My models don't fail. I fail using them because I try to do things when I've even told you not to do it. Don't try to trade the morning session because why? The approach to trying to force precision in days like when we have a large range day on Wednesday where it's a big down day, the following morning session, you want to avoid that because it's going to evade you when it comes to precision. But because I'm ICT and I like to do things to prove a point, well, I proved the point that I'm human too, and I lost 2 times yesterday, back to back, just like that. And then I went and got it all back with more. So I'm not advocating that you do that. That's the part of me that makes me not a good mentor because I'm willing to break my own rules because I'm good enough to come back from it. And when you're first starting to do this, you're going to want to do those things because you hear me say that, or if you watch me, or if my students see that, they say, "Oh wow, he had two losing trades. It was a little cringy because you're supposed to be ICT and you just had two back-to-back losing positions, right here. And what would the internet think if it got out?" And I'm sure they all were running out there in their little circle jerks, like I was joking with my crew yesterday. And I told them, I said, they ran out there real quick. Watch this. ICT lost two trades, but you'll never hear him talk about it. He wants everybody to believe he's so good, he's perfect. But I come out here, I told you, if I have a losing trade, you're going to see it. I'll tell you about it. I'm not afraid to talk about it. In fact, it's helpful. It communicates the very thing that I teach you not to do. Don't trade in the morning session after a large range day. It's simple, isn't it? It's simple. But because they're my concepts, because I codified them, and because I'm a little bit better than the average bear, I'll chance going out there and doing it. And when I'm doing it like that and it's profitable, when I'm able to say, look, see, I was able to do this, I'm not flexing and saying, look at this, look at me. Look. I can do that without doing that. But it's me saying, don't count this as something as a skill set for you to acquire because it's simply me doing something where it just happened to work in my hands at that time. It's better for me to try to do these things in the evidence division of, see, this is why I teach the way I teach. And I know this, it pisses people off when I say stuff like that. But if I only come out here and teach on days that are just real easy to trade, and it's all one-sided, wouldn't that wouldn't that kind of communicate to you that you're going to always know the days that it does that? Contrast that with I teach a lot around days and periods and conditions that are not going to be conducive for very precise delivery and price. Have you noticed that? Have you noticed that in this 2024 mentorship? Because that's the part I told you in my 2016 and 2017 paid mentorship, that every time that someone joined my paid mentorship, they got those same lessons that are already on my YouTube channel for free. And they had to go through all that core content to understand what I just told you. So that way they don't have to go through it. But because they didn't want to be taught in hard conditions, if you're not really ready to learn, you're going to come to me and say, okay, teach me how I need to learn because I know how I should be taught. Well, if you know how you should be taught, then you know everything, and you're the teacher then. I'm not gonna waste my time with people like that. So I always build in a method in my lectures where if you're that way, you're gonna get bored with me or frustrated, and you're gonna stop watching me, and that's exactly what I want you to do because I don't have time for you. You're not ready to learn. But for someone that's willing to subscribe to the ideas that it's going to take a lot more time than you think, it's going to require patience, and you want to learn how you're going to ruin yourself. You have to identify where those quicksand periods are, where that oil slick in the road is, or that big pothole down the road that is going to destroy the front end of your car. Okay, you don't take your high-end sports car and drive over top of potholes. You try to avoid everything that's going to cause damage. So as a mentor with 30 years plus experience doing this, I know where these troublesome areas are going to be in the marketplace because I needed to know that. I blew a lot of accounts when I was 20. I roasted myself continuously back then because I was a cowboy and I knew I had a purpose in doing it. I was literally funding research and development in my own hands, and I was learning a lot of things, but I didn't understand or appreciate the measure of scar tissue that it was creating in me. So when I teach and I lecture, I teach you these things and I tell you, don't do these things so that way you listen to me because it's not you that I'm talking to. Remember that. It just feels like we have this connection together because I'm talking and I'm picturing my kids in my mind. I'm seeing Caleb and Cody and Cameron and my youngest son and my daughter and any of their children in the future that I may or may not ever meet. I'm talking to them in mind. So that's why sincerity is coming out of my mouth. I'm speaking from my heart. I want them to learn from my mistakes. I don't want you to repeat what it is I've done because it's hard. It's hard to grow outside of that. That's what caused me to take 6 years to figure out everything because I actually figured it out a little less than 3.5 years, but I spent time working through stuff, trying to tinker with things because I thought I could make it perfect. And I was never able to get perfect. So perfect is always going to elude you. It's always a passion of mine, but I know enough that I'm never going to hit perfect. So if you're looking for periods where understanding where you're going to hurt yourself, and if you have an educator in anything, it may be trading, it may be another skill set or hobby or sport, if they have a way of teaching you how you're going to hurt yourself, how you're going to find difficulties, and if you can observe that beforehand, Isn't that an advantage? Now contrast that with some of you that are brand new. Say this is the first time you watch the video from me or a live stream, and you're like, get on with it. You're not teaching anything. I'm actually literally teaching you exactly what you need to know, but you don't know that you need to know that yet. When you get out there and you try to use my stuff or someone else's stuff, or you follow somebody's signals or whatever, and you start losing real fucking money, all of a sudden you're gonna be like, I need someone who's gonna help me fix myself because I can't think straight. Everything I'm thinking about is toxic. I'm afraid to get into a trade. I'm afraid to take another losing trade if I follow this guy or follow this model or if I follow this approach or if I just trust my own intuition. I backtest and backtest, and then all of a sudden you clam up. You can't do it. It's because you don't know if that moment you're ready to push the button is going to be a moment of hardship, where it's going to be much more difficult versus when it's real easy. When it's low resistance liquidity runs. I'm going to explain what that is, okay? Because yesterday, study intraday price action on Thursday. Go through your 15-minute time frame, 5, 4, 3, 2, 1, and if you have the ability to go down to the less than 1 minute candlesticks, do that. And you'll see a lot of back and forth, the overlapping of the ranges. Once it creates a run, it comes right back over top of it. That is high resistance liquidity run conditions. That means that you're going to get chewed up, spat out. You're going to either blow your account, blow your combine, go into severe drawdown, or full tilt and be afraid to do anything the rest of the day. And because that happened to you yesterday, you're going to be fearful of taking the trades when it's like it is today, when it was low resistance liquidity run, where you don't have a whole lot of give and take and back and forth. It's just find me a PD array, get in it, go. Gone in 30 seconds. Okay, so what I defined in here, and I'll kind of walk you through this. This is pre-market, pre-session. If you look at the high here, there, that high is this rotation and then start to move all the way back down into this area in here. So what I identified is the bodies of the first high here, and this was like a stop hunt. So I ignored that. So I'm looking at this reference point here as the low, and it comes back down and hits it here. So pre-market, that means before 9:30's opening bell, 8 or 10 minutes after 8, okay, you're in a macro. So what's it going to do? It's going to spool, trading all the way back down, booking price down to the low over here. If we can define that range, okay, once we have that, we can calibrate that to whatever the high and the low is at the time. Once it retraces back down to a discounted range and starts to move higher, what is it doing right there on that price run? It cleared this high. If you're really, really bullish, you can use this short-term high here. That's a shift in market structure. But here, this really nails the deal and says, okay, we've had 2 periods or 2 points of reference where the market traded above a short-term high. And then it gravitates right back down into order block, buy side balance, sell side efficiency, range high, range low. With those 2 reference points, and we're bullish, and we're expecting a large range day, and we're expecting that there's most likely not going to see, if we have a large opening range gap, we're not going to see what? Much, if at all, of a retracement into the opening range gap, because it's going to be go, go, go. It's Friday, doesn't have a lot of time. It's got to run aggressively for that buy side liquidity in the 600s. So because all those factors coming together like a perfect storm, it's beneficial for you to try to start looking for setups before 9:30. I get questions all the time. What made you want to trade before 9:30? You teach silver bullet. I thought we're supposed to be trading silver bullet. I thought we have to wait till 10 o'clock. That's you. If you're going to use that model, you have to wait till then. But there's always silver bullets. Every hour there's a silver bullet. What are we talking about? I taught this. But if I give you a model to start with, I'm not saying that that's all I'm going to do. I'm educating. I'm giving you a plethora of different ways to do this. There's more than one way to skin a cat, and there's lots of ways to use my concepts. And that's wonderful for you as a student because that means that I don't have to press you into a mold, which is what the silver bullet is at 10 o'clock. That's me pushing my son Cameron into a mold. This is the time you have to trade. This is the only thing you're going to be able to do. You cannot do anything else but this, because it forces him to start somewhere. Because he's my son, I have authority over him as his dad, even though he's old enough to make his own decisions. He's outside my home now. But because he has that respect and that fathership role I have over him, I'm I'm tapping into that to kind of like say, look, yeah, I'm your dad, but I'm also in this capacity, I'm your teacher, I'm your mentor. So I'm going to reduce your focus to this because that'll give you a baseline. You have to start somewhere. You got to get some kind of baseline experience. And it goes back to when people come to my YouTube channel. Where do I start? Pick something. You can't go wrong, but you have to have some kind of baseline foundation because unless you start somewhere, and there is no perfect, really, there is no perfect starting point. But now, because we've done this mentorship in 2024, because I've been doing it over live price action and doing things, showing you what the market's going to do, pushing the button, go back and listen to the lectures, and you'll see me do it. The whole idea of looking for this repeating phenomenon is not enough. It's identifying where you're going to wreck yourself. That's why 99.9999999% of educators out there, they don't touch this topic because they don't fucking know. They don't know. Every day is a trading day until you get your ass handed to yourself. And you don't talk about those days. You won't show your funded account stuff then. You'll just pretend it never happened. But when it's working in your favor, then you'll broadcast that stuff. And that to me is a little bit of a disingenuous uh, motive because I am a realist. I am a realist as I teach. I teach through a demo account, paper trading, because I'm not licensed to give financial advice. But I am not a demo trader in the real world. I have to do things to comply legally in the United States. A lot of you yahoos out there, whether you're doing it in the United States as an American or outside this country, in the states, there are governing bodies that will absolutely grab you by the lapels and say, "Come here, son," and make your life hard, make you pay fines that you probably can't afford, maybe even jail time, and disbar you from having any ability to trade in the marketplace. That can happen. There are consequences. So because I don't want that problem. Okay, I don't need that trouble. Okay, I do things, and even though you may not like it, it may. Oh, you're supposed to be ICT. Let me. As much as I love teaching all of you, I don't love you all that much to risk that kind of stuff for my personal life. I have a lot to lose. So you can all laugh and say, "Oh, it's the demo ball." I called myself that. I do that for my own legal protection. But it doesn't change the fact that the things I'm talking about over live price data, either it works or it doesn't. Period. If it doesn't work, then you know right away. There's no further necessity for you to please spend any more time with me. But you keep coming back here because you see it working. So because we have Friday having a large range day likely, and the direction was given to you because we're focusing on buy side liquidity, that was given to you on Thursday's tweets. Friday's going to start right out the gate, real quick, real fast. So we may not get a return back in the opening range gap at all. So that means trading pre-market. Whenever I think that the market's likely to create a very large range day, or if it's so one-sided directionally, there's the two caveats to it. I will many times elect to trade pre-market before 9:30 and not do anything as entries at all after the opening bell because I'm already positioned before the 9:30 bell even uh, starts. I'm in there usually between 7 o'clock and 9 o'clock. Something in there, I'm positioned and I'm holding. I probably have had multiple partials, and I'm waiting to see the continuation and expansion through and blow off move that occurs during the opening bell and the opening range of 9:30 to 10 o'clock. And then if 10 o'clock affords me a silver bullet that would allow me to do a longer term hold and convinces me that I should go through the entire lunch session, and then see if I can pyramid during the lunch macro where it retraces, goes down into liquidity. I can add to that. Or if I've taken partials off, I can add them back plus more because I have unrealized profit behind me still because I've entered so early in the day before 9:30. It just gives you a whole different perspective on what we're doing with the daily range. It's not defined just because at 9:30 it opens up and there's a gap. There's a whole lot of other things going on before 9:30 opening bell. But not every session before 9:30 should be traded. Not every one of them should be like that. There's going to be a lot of times where the market doesn't do much at all pre-market. And then at 9:30, everything comes alive and everything is very easy to trade. But because all the things I talked about in this lecture this morning coming together and coalescing in one day, in one session, very limited time because the week's getting ready to close, just a real big pool of liquidity above us. And the split delivery on the economic calendar, we have 8:30 and 10 o'clock news. And we were already likely to have a large range gap opening. So don't look for that opening range gap to fill. Wait for it to just rip and run to its unfinished business where the smooth areas are on your chart. So if we can define this range from the high down to that low, as I mentioned a moment before I went on to my rant, we can then look at the grading aspects. So again, this is for the folks that say, if I post something on Twitter or if I post a video on YouTube, you don't see my comments, okay? Um, I, I have them set to review because there's a lot of people posting some weird stuff about, I can't remember what it is, but it's always like, I'm so thankful that you talked about some AI 14 something, something, whatever. It's probably some kind of crypto. I don't even know what it is. But when one person posts or a bot posts on that, there's like 80 different responses to that, kind of like promoting whatever that garbage is. So if it ain't that, I got one or two people come in there. I'm a scammer. I'm a fraud. But the rest is like, thank you for sharing all that stuff. And it would look like I'm paying for that stuff. And I'm certainly not paying for bots to leave comments, okay? You should use my comment section on my YouTube channel as your own little study reference point because the comments that you leave, you can write down in comments certain minute markers and say, this is where ICT talked about, order blocks or when order blocks aren't likely to work. It allows you to have like a scrapbook or note-taking aspect because you're the only one who can see. I can see your notes, but no one else can see that and it doesn't clutter up. You don't have to sort through all the comments to find your bookmark where you watch the video up to this certain minute mark. Like you're wasting your time, you know, when you don't use that resource because every one of my videos has that ability for you. But the train of thought. Oh, the question always comes up with, why'd you pick that fair value gap? Now, some of you are thinking, yeah, that's the question I've been wanting. You never answer me. When I'm picking specific fair value gaps, or if I'm picking order blocks, or if I'm looking for any specific PD array, it's not simply because it's a down closed candle makes it an order block. It's not simply because there's a separation by one candle defining an exposed single delivery or fair value gap that makes it a tradable fair value gap for me. And this is not going to be encompassing the entire aspects or the complete treatment to a fair value gap, but it's certainly going to divide the waters because there's a lot of people out there that are teaching fair value gap and they don't know what they're talking about. And I want you to take notes here because you're hurting your students when you don't know this. And you're also messing up the consistency that my concepts have because when people watch your shit, and you're not crediting me, you're not taking the attention back to my channel where they can further learn. I don't mind that you're demonstrating it in your own YouTube channel. I don't care that you're doing that. Go do that. It's wonderful. I love watching my students do that. But when someone steps out and they pretend they're going to be the mentor with them, you need to sit down. And I mean that. Like you don't know what the fuck you're doing. And you're literally scamming people and defrauding them if you're getting paid to do it. Because I'm telling everybody, there ain't one person out there teaching my concepts that's doing it right. End of story. That's it. That's it. You're looking for fair value gaps that match this, okay? If you're looking at a mentor, pseudo mentor, okay, a faux professional, okay, the fake professionals out there, if they're defining anything outside of this, right away, you already know that they don't know what they're talking about. And go watch their old videos, and you'll see them doing it wrong based on this information, okay? And that's why their shit didn't work then. When you have a dealing range, and we define that from this high here, and it's dropping down back to a PD array over here. This was a stop run. So we nixed this. We don't even pay attention to this candlestick. All that was a little bump to take that high, and then price went lower. Let me take that off. I wasn't supposed to do that yet. It drops back down to a discount. I'm looking at this high here and the bodies, because this wick is just like this one. It's doing damage. I'm going to go back to the bodies here. And I showed you by drawing that out in time, that's the return to it here. And then we have a shift in market structure. You can define it with this high here. And there's nothing wrong with that in this case, because we are expecting what? A large range day to deliver today on Friday, because Thursday was an inside day. Using this one, it qualifies it even further, because when it trades above this one, it's one candle, and then the next candle trades above that high. So it shifts market structure bullish. So any retracement back down into this inefficiency here should be viewed as what? A discount array. Now, because this high is the highest high in this retracement, in a market that's bullish, we can grade that price swing. This is not quarters theory. It's not quarterly theory. It's none of that stuff, okay? This is grading a price swing. I do this with actual dealing ranges, as you see here, and I also do this in price runs where I either expect to enter or when I actually enter the trade, and then where my target is. I know by doing what I'm about to show you here, and you've seen me do this before, but if it's the first time, I'm kind of give you a preamble of why it's important, what's its usefulness to it. I can predict where my future PD arrays are going to form. Now, this is something that I can transfer to you, but I already know where fair value gaps are going to form before the dealing range even forms. And I know that's hard to believe, but that's the superpower ICT has. So, and I know that's going to cause a lot of static, and people are going to put sound bites about it. This is where he said, yep. And you're going to talk about me, and people are going to come to the channel, and they're going to learn. That's how it works. So here's your dealing range, okay? And equilibrium is the halfway point right here. So ideally, your best entries, lowest risk, highest yield in terms of R multiples, is going to be entered on a long at or below this line. Pyramiding has to be limited to this price level here or lower. Now, is that ambiguous? Is there a lot of moving parts to that? Nope, it's very simple, straightforward. Now, how can we use this information to pick the right fair value gaps? How can we use this information to pick the right order blocks? Oh, man. You're going to have to come back on Monday for me to get to that. I'm just kidding. You were pissed off for a second. Oh, no. I love my job. Here we have the upper and lower quadrants. Okay, and this is when you want to take a picture. You can see that these are my quadrant levels. Optimal trade entry level here. This, when I need to pull up the OTE, I just change the 0.75 to 0.725 or 0.79 because I round it. I don't do the 78% returns. I do 79%. And then the rest are, these are over here. These are extensions that they're not going to be taught to you until they're in the book format. It's using the opening range, gap, and standard deviations. So it kind of picks the high and low of the day. And I know that's a little cliffhanger for you too, but what we're seeing here is the quadrants that is grading this dealing range from the high down to that low. Now think about it. Yesterday, I took your attention and told you to start focusing on the relative equal highs where everything was left smooth in the marketplace. That's our bias, it's bullish. So that means we're going to be looking for draws on liquidity for buy side. We're not interested in shorts. So that means you're going to look for bullish order blocks. It means you're going to look for bullish breakers. It means you're going to look for bullish fair value gaps, or you're going to look for fair value gaps that were initially characterized as what would be short selling or premium that's going to be broken and then treated as an inversion fair value gap. You see how everything changes to these are usable PDA rates. These are reference points that now you can suddenly build an idea or an expectation around versus every down close candle should be an order block. It's not. It's not. So at 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here, so that's a swing high. So when the market breaks above that, that's a shift in market structure. So we can see it as such. So that's a shift in market structure. Go back and look at model 2022 mentorship videos and you'll see it's very similar to that. And then it displaces higher, and then we have another swing high. This candlestick's high is lower than that one, and then the lower high on this one. So there's a swing high there. And it broke both of them, leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must, listen folks, listen, okay? It must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, spooling at 8:30, that's the only 30-minute delineator for a macro. Everything else is 3:15 to 3:45 for the last hour trading, and then you have the first 10 minutes to the top of the hour and the first 10 minutes after the top of the hour. That's every hour macro. Okay, so there's your little skinny on the macros. But 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. So what happens if you're anticipating something here and just meanders around or goes lower? Do nothing. Sit still and wait for the 9:30 opening bell. But because I built the case around everything I'm talking about today, see, we're already inside of the equivalent of 2 chapters in a book just with this live stream. Just this live stream talking about the impacts of knowing how to use the economic calendar, knowing how to use the day of week phenomenon, understanding the pools of liquidity and the PD array matrix, and how to now use that information and define which order block, which fair value gaps are the one I trade off of, because that's the one the algorithm's going to use. That's authorship. That's fingerprints, okay? By defining this with the quadrant level here, your fair value gap or order block, which is this down close candle right there, is that below that quadrant level? Yes. Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because we have an order block there. That order block right here. Why am I using that one? Why am I specifically using that one? Because it has the lowest down close in with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. So half of that order block is a mean threshold reference point. It's not consequent encroachment. Consequent encroachment is gaps or inefficiencies or wicks. Okay. When it's a candlestick body, in this case it's a bullish order block, half of that range is mean threshold. That price is 452.75. What's the low of that candlestick? The fucking low of 452.75. folks, that's perfection. Elliott Wave wishes he fucking knew this. Sam Seiden has no idea how to fucking do that. No idea. Well, maybe he does now. He's watching my videos and stuff. But there is no other school of thought that teaches that. None. Wyckoff has no fucking idea. No idea. He's rolling around in his grave right now, wishing he had a fucking pen and pad right now. I wish I would have put that in my writings then. He didn't know about it. Okay? And everybody that uses Wyckoff, they don't have this information in there. Sorry. But that's perfect to the tick. But that's supposed to be buying and selling pressure, right? Buying and selling pressure on the next candlestick right there. What's the candlestick low there? 20,452.75. Not one deviation off by one tick less or above. That value perfectly delivered. And you're going to tell me, you're going to argue with me that it's buying and selling pressure, the randomness of everybody coming together and buying and selling on their bullshit that's going to cause the market to stop right there, right? You know, it takes more faith to believe that than it's simply that there's an autonomous price engine that literally is controlling the fluctuations in the ebb and flow until it's manually disturbed by intervention. That's what's going on. And you can argue with me all you want, but you're never going to convince the author. You're never going to convince me, and you're never going to convince my students have now seen it, they use it, they make money with it. They can predict it, they can anticipate, they can see it. And some of them have communities where they're doing it in the witness of others continuously. And you're never going to convince them that they didn't witness it. Not just once, not once in a blue moon, every fucking day. Now find that in anything else out there. It's not. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. See that? So this volume imbalance, it delivers it. What's it missing? Buy side and sell side delivery. So it lays a body up in there. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium. Meanders around in here and then causes what? Another displacement. What is this candlestick right there? What is that? It's a fair value gap. Well, ICT, why didn't you use this one? See, he doesn't even use his own logic. He doesn't even use his own stuff. He's making it up as he goes along. Why didn't he use that fair value gap ICT? Why aren't you using that? Because isn't that a fair value gap? Isn't that a buy side and sell side efficiency? Ain't that the thing? Ain't that the thing? No. Because where's that? The majority of the body of that buy side and sell side efficiency is what? Above that quadrant. Uh-oh. Starting to make sense now, isn't it? So here we have what? Equilibrium. We're at that precipice where if you're building a position in all this down here, pyramiding, like you've seen me do many, many times, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less if you're going to be pyramiding. Otherwise, if you start adding up in here or above it, you're really just tossing good money after potentially you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Do you remember? Do you remember what it is? Down close candles will support price higher, and inefficiencies will leave a portion open. Is that hard to remember? I've already said it before, but you probably forgot. But now this is the time when you write it down in your journal. Every day when you first start your day, have that written down in front of you on your notepad. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you what? We're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move, or don't trade. That's the characteristics with it. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. So because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range, when you're bullish, how could you use that? Now you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave the lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, which is this, watch. That's this line right here, okay? It's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal, because you would expect what? Only a partial entry into that blue shaded area or fair value gap. Trust me, my charter members are flipping out right now because they were never taught this. You're learning it with them. So this is institutional order flow entry drill. And just because my watermark is not on this video, if you upload it on your channel to try to make ad revenue of it, I'm going to yank it down and put a copyright strike against it. And if it's a channel you're already making ad revenue off of, it's going to hurt you. So don't do that. You don't have my permission. So this is institutional order flow entry drill. Or you can use the upper quadrant of this range, and that would be done like this. And you would use that price plus one tick, that 462 3/4 plus one tick. And that would be your entry. That would basically give you a very specific, not a zone entry, a very specific price level that would constitute an institutional order flow entry drill. Institutional order flow entry drill is a entry model where you're expecting a fair value gap to be traded into, but not fully close in. And because you're expecting low resistance liquidity run conditions today, because of all the things I talked about in the first quarter of or first half of this lecture today, all those things building and coalescing with the idea that it's going to be a large range day, it's going to be explosive at the opening, any opening range gap should not be expected to be traded to, even though there's a 70% likelihood that half the gap should be repriced to in the first 30 minutes. Throw that to the sidelines and expect them to just really make a mad dash to get to the liquidity that we've outlined. So low resistance liquidity run entries in here, low resistance liquidity run entries here, and then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. Now, you can take that and enter on it. There's nothing saying that you can't use that as a model. I'm not saying that I'd be comfortable doing that. I could do it, but because I have to have principles and protocols and procedures to follow, because otherwise I'm left to my flesh, and my flesh will do like it did yesterday and put me in things that I shouldn't be doing. So when I try to fancy dance and finesse my own stuff and try to let my own experience dictate what I should do versus the process, the protocol, the model, the rules, stay on the right side of the road. Don't cross the yellow line, Michael. Well, if you're listening to me, your trading ends on the entries here or less. Anything above it, you're just using it for management purposes. So when this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the quadrant, upper quadrant, and less. See that? So what does that create in here? This candlestick's low, that's an institutional order flow entry drill. That's an institutional order flow entry drill. That's an institutional order flow entry drill. Leaving what? Portion of the range open. That is telling you continuous feedback that yes, down close candles consecutively, that's an order block, draw that out in time, hits it, Does it support price? Yes. In and of it by itself? Nope. Half of this gap at equilibrium and an order block, this portion should stay open. It should not trade back down to this one because that's a breakaway gap. All those things are signatures and characteristic of low resistance liquidity runs. Folks, there's nobody else that's taught that stuff. And that's the stuff that I didn't know that I needed to know. Because when I trade in these environments, it's flawless. That's why when you watch my executions, you're like, what in the hell? And you see my stop losses and they're ultra tight and I'm sitting comfortably and they're getting real close to it. I'm not worried about it. I'll add right there. I just shared it with the other day. I added right into it. When it was getting close to my stop loss, more, because I know your jaws would hit the floor. And then all the comments that came behind that trade. What in the hell? Yeah, because I'm using what I'm showing you right here. When you enter in here, your stop loss can be just below this candlestick's high because it's not going to go down to the lower bottom of that fair value gap because we're in low resistance liquidity runs. The algorithm is controlling this. So if you know what the mechanism is going to be when it is seeing these things based on defining your dealing range, knowing where equilibrium is, if you're bullish, you're buying at it or below it, in every fair value gap, or in this case, order block. Isn't this an order block? Down, close candle, down, close candle. Two consecutive down, close candles. That's all one range. It's doing what? It's delivering price lower. Does that down, close candle support price going higher when it comes back down to it here? Yes. Then price goes where? Higher. Down, close candles here. 1, 2, 3. And then it creates that final institutional order flow entry drill like it did here in this range here, going right below the high of the fair value gap. Same thing here. This candlestick's low. That's the high of this blue shaded area or fair value gap. So it's trading back down into that. But isn't that also reaching into, I lost my train of thought. The order block supporting price, right? When we're seeing price trade down into it, this candlestick here, isn't that an order block? Isn't a down close candle when price is moving higher? Inside that candlestick's range, it's trading down into it. And it's rare that it does this, but sometimes it will. It'll trade to the low of the candlestick. I don't like that. I would never enter on a trade like that. I want to see half of a bullish order block, the mean threshold or higher to its high. I want to see price use that portion of it to trade down into and then repel price away. When you're looking for dojis or tails beneath the candlestick, like we're saying here and here, those are forming inside order blocks or inside fair value gaps. When the order flow is bullish, you can anticipate these things forming. That's why when you look at my entries, I'm always entering on the very lowest candle or the one candle before or the one candle after the lowest candle when I'm bullish. Don't take my word for it. Go back and look at every example I've showed when I'm executing with live data. No market replay. I'm using what I'm teaching you right here. And the market then leaves this range and breaks above the dealing range here. And then we're going into what? We're going into that 9 o'clock hour. And we trade up into new week opening gap here. I almost said something that would have been a little too crude. Not in the sense that it would have been vulgar, but I would have almost mentioned someone's name, but they're probably watching and they know I mentioned this price level, 20,495. I mentioned that yesterday. That was my target, and it hit there. I prompted them when it hit too, by the way. We traded up to just short of consequent encroachment of the new week opening gap. Now this is current new week opening gap. Notice I don't have 1,000 different new week opening gaps. I don't have every new day opening gap on my chart. Some of you are leaving comments saying that I am so confused. I have all these lines in my chart because you're trying to put everything that's in the kitchen sink in front of you. And I don't do that. All you need, sincerely, all you need is a draw on liquidity. That might be a session high. That means like a morning session or a PM session from the previous day. a London session high or low, an Asian session high or low. Wherever you think the market's going to gravitate to for the purposes of tapping in and engaging liquidity, where is it smooth? Where is there a single high? Because it isn't always relative equal highs and relative equal lows. That's just the easy things that a new student I've learned that it's very easy for them to spot that. Just like a fair value gap, you can see there's gaps, but you just don't know. Now you know how I formulate an idea around the fair value gap that I want to trade on. Just because it's a gap doesn't mean that's the one I'm trading. And that's why these yahoos out there will say, "Oh, it's running through the fair value gap," because you're a fucking idiot. You don't know what you're talking about. You're listening to other people that ripped me off, and they're running mentorships, teaching people for pay uh, monthly fees when they don't themselves know what the hell they're doing. They have no idea what they're doing. But watch and see how this all finds its way into their mentorships now. Watch and see. And you still don't have the half of it. That's what the books are for. Twist the knife, ICT, twist it ever so slowly. So here is the consequent encroachment of the new week opening gap. Now, again, the new week opening gap is the difference between 4:59's closing price on Friday, Eastern Standard Time, to 6 p.m. Sunday, Eastern Time's opening price. And then the difference between those two price points, the halfway point, is this little dotted line right here, which is consequent encroachment. So we see it fail to get to it initially here, and then it drops down outside of the new week opening gap. Does that mean it's going lower? No. Then the market rallies back up and trades to the high of the new week opening gap. And then now what do you want to see happen? Well, remember, we have all that liquidity up in the 600s. We still have some range to go. Look, we're in the 400s still. The market drops back down to some random level, some absolutely random level, some rando, stops dead in its tracks and starts delivering price higher. And then ahead of 9:30, they run against those individuals that are on side. And all this movement here, even the Model 2022 guys, ICT stuff. Oh, this is a classic ICT Model 22. We have a shift in market structure. There's a fair value gap right there. It trades all the way back up to a premium. And then it's also optimal trade entry. And look at this. It's selling off. Yeah, look at that. Beautiful. If you didn't take a partial, your ass is handed to you. It's just being delivered back to what price level? Consequent encroachment. Consequent encroachment. Consequent encroachment. And then at 9:30, all hell breaks loose. Boom. Manual intervention. Yes, because the hand says we're not letting those buy stops off the hook. Rip and run. You see this delivery. Stopping dead in its tracks on here. If you never would have been taught the new week opening gap, look. Settle down. I didn't invent a gap opening on Sunday. I didn't invent that. I codified the concept of using that gap. We're on fucking Friday, folks. That was on Sunday. It's been trading around, up, down, through, and all that stuff. But the time it's using those levels with the narrative that it's likely to go higher because the bias is bullish because it's an election year and we're not trying to pick the top in a primary bull market. When you have these things come together, you have blue ribbon results. You have too good to be true type results. That's what I'm showing you examples on. I show you examples when I know everything that I teach you is in my favor. If I try to trade every fair value gap just because there's three candles in the chart and one of them single passes through between the two, and I use that as the entry model for going long or short without a bias, without the right time of day, if I'm doing it ahead of an economic calendar event that's going to probably be used as a smokescreen to move price around, am I going to be successful at that? Fuck no, I'm not going to be successful at that. No way. Nobody would. But because you're a goober and you're trying to learn how in 5 minutes and you're listening to other people that know what the fuck they're talking about either, you come here with the preconceived notion that it should be perfect and it should be taught to you in one fell swoop in a 5-minute trainer, and there it is. And there's too many facets to the markets. They're too complex for you to have a one rule set based model where this is all you need to worry about. That's not realistic, folks. You have to have a draw on liquidity. You define that by liquidity above or below session highs and session lows. That means Asian session, PM session in New York, AM session in New York, the lunch hour in New York. That's 11:30 to 1:30. What's the highest high and the lowest low between those two reference points? That's what the lunch macro is going to identify and attack. Then you have the pre-market between 7 o'clock and 9 o'clock. What's the session high and low of that? Then you have the London session. Then you have Asian session. How many opportunities is that all in and of itself just for drawing liquidity? That's a lot. You're never running short on opportunities. But the opportunities to reach that liquidity, does it really match with what the economic counter is affording you? Does it give you, I just looked at the time, I'm going over, aren't I? Oops. Good thing I'm not getting paid hourly, huh? The boss would be pissed off. You're working too much overtime, ICT. Go about to find your ass a pink slip. Get the fuck up on out of here. We'll find somebody cheaper. You ain't gonna find nobody better, baby. So the rundown into consequent encroachment, ripping higher, is all part of this larger range delivery that has been encapsulated around Thursday creating an inside day. So there's a compression. And then we know there's a large range expansion on Friday likely to happen. And you want to be pre-market entry and then let it go. And then it trades up into the pools of liquidity that we were looking for. Here, gyrated around, came back down into a pool of liquidity here, relative equal lows. You see that? Trades lower, lower, rips, makes a higher high, and then we're just consolidating around that. And then we had this shit messing up. I thought that was a big drop when I had my crude depiction of a daily range. Did you think that dropped on your chart? Did you quickly look? Where the hell did that come from? Thought you missed something too. I'm looking at a laptop, so I don't have all my other charts in front of me. But look how it's just meandering around. That's what I'm saying. If earlier in the beginning of the session, when we were trading up here, I said you would be done. If you're a morning session trader, if you're a day trader, you'd be done. If you're a position trader, a swing trader, you'd have 80% of your position off, and then see if it wants to continue going into the afternoon session. It may and may not. But at this point, if you haven't banked 80% of your run, of that, you're doing it wrong. Okay. Um, take that off. Take that off. That off. And that's how you use pre-market session when you're anticipating a large range day. How do you anticipate a large range day? By looking at the last 3 trading days, getting the average of the last 3 trading days. And if you are closing today less than that average daily range, that means that you are in a small range day. That's mathematically defining something that is very simple. Now, it's extremely sensitive, so I don't mind that because I have a little bit better perception on where the market's going to go and like bias. I know what I'm looking for each day. I'm trying to go in here and look for it. But if you want to break it down to 5 days average daily range, and if you start creating daily ranges that are less than the last 5 days, you are in close proximity to a large range expansion day. And large range expansion days are 90% high resistance. I'm sorry, I said it wrong. 90% low resistance liquidity run. So a small range, or that is that it's not a big explosive large range day on a daily candlestick. If it's not a large day, then you're probably going to be met with high resistance liquidity runs. Not all the time, but 90% of the time, large range days are low resistance. That means there's very little give back, and you can see it here. It's just like off to the races it goes, and it's just like go, 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 go. Another characteristic when you're trying to trade in low resistance liquidity runs, don't be in such a rush to take partials off. Manage those days by your stop loss. Don't be in a hurry to just pay yourself because you're going to be like a deer in headlights. You're going to be scared because it's going to be running in your favor so fast. It's scary. If you've never made big money, if you've never been in a trade where it's just ripping and taking off and moving hundreds, not 10 handles, not 20 handles, not 30 handles, not 50, hundreds of handles in very short time, it's going to be very intimidating for you. So If you know that you're in a low resistance liquidity run days, move your stop to a reasonable level where you can just take a break and walk away from it. Have your limit orders in. If it hits your target, you're done. But walk away from it. Go do something. Take a walk, go work out for 20, 30 minutes, and then come back. And you'll be rewarded for having been in it a little bit longer, and you won't be watching on well, in this case, a 15-second chart. Every little fluctuation and minor movement is going to scare you out of the trade. It's going to make you feel like every little possible retracement is the top of the marketplace. And without having an idea where the market's gravitating to, by having that reference points of those liquidity, remember on the 15-minute time frame, that's these highs here. That smooth right here, high, lower high, lower high. This is a prime candidate for a run on liquidity. And you've been trained to look for that in price action. And look how this quickly ran right to it. That's not random. But that speed, that element of speed, is because of the day of the week phenomenon. They don't have a whole lot of time. They only have today until 5 p.m. Eastern time. Are they going to wait until the afternoon to get to there? No, they want to be done. They don't want people to sit there and think, oh, maybe I should square my positions going in the weekend because there might be something that happens in the Middle East and I wake up to gap risk on Sunday. They don't want that. So they intervene manually and boom, you get that. Doesn't this look like FOMC? Look how fast that ran like that. That's not algorithmic. That's intervention. That's what that is. Okay. So there's a lot of things that you have to learn before you start going out there and trying to make money. There's a lot of things you have to learn that's going to prevent you from making said money. And as a teacher, as an educator that has real world experience, I've made money and I've lost money. And I'm telling you, losing money sucks. It sucks. And I have learned lessons that no other author, no other teacher, educator, and I bought thousands and thousands and thousands of shit. And none of them ever scratched the itch. They never gave me the things and the tools and the mindset to say, okay, I know how to buy into a bullish market. You all know how to do that. You know how to short in a bearish market. You know how to do that. But how do you manage your stop loss appropriately? Nobody fucking writes books on that. Nobody knows how to do that. They just say, okay, trail it below the next swing high when you're bearish. I'm sorry, scale your risk and reduce it by moving your stop loss to the lower swing high when you're bearish and keep trailing it down. If you do that in high resistance liquidity runs, you're getting stopped out. If you relax and don't do that in low resistance liquidity runs, you're not going to get stopped out prematurely because the market's going to be allowed to move around a little bit. And it's less likely it's going to move to those levels anyway. How many lows did you see get retraced on in here? On a 15-minute time frame, 5-minute time frame, 1-minute time frame. I mean, shit, look, it stopped dead in its tracks at consequent encroachment twice. Here and here. It didn't take sell side. It's not interested in that. It's aiming for what? These suckers up here. They're pissed off right now. I wish I would have took my profits on Wednesday. I wish I would have got out of my shorts on Wednesday. Goldman Sachs is like, what the hell? This guy did it again. All right, anyway. Um, I would honestly love to talk to you some more, but it's Friday, and now my landscapers are here too, so they're competing with me, and they're distracting me. And as you get closer and closer to my pool, they're going to be louder, and that's going to be in my head as I do it. And I've already given you much, much more than I intended to do today. So we're going into the weekend. If you're in the United States, if you have not prepared to vote, go and vote this year. I've never voted before. I've never voted before. I'm not going to tell you who to vote for, but you should be voting this year. You should do it. If anything, just participate in it, regardless of who you're voting for. I'm never going to tell you who to vote for. I can tell you who I'm not voting for, and that would seem like influencing you. So I'm not going to do that. But as we get closer to this election, we're probably going to see a lot of volatility. And if you've never studied price action on election night, that is a wild day. In the evening time, it creates this really wild spike up and down. They clear the board. I think it's going to be exaggerated this year. I think it's going to be an exaggeration, not just simply on election day. I think it'll go like that for a few days. And if they don't have the results, which if you've been paying attention, they're already building a narrative to expect that they won't know for weeks. And if you remember back when Gore and Bush presidency was done, it took weeks for them to come out and finally say that it was given to them. So Bush was identified as the winner at that time, and everybody was waiting on bated breath to figure out who was the winner of the presidency. There's a whole lot to expect in terms of tomfoolery, a lot of emotional response to who may or may not be the winner. We may not know for a while, and that's going to cause a lot of contention, a lot of stress, and it's going to cause a lot of perceptions about risk to be skewed. So, what does that mean? That means we're probably going to see a lot of volatility. And my advice to you is what I told my private mentorship students: gear down in your leverage. If anybody's telling you trade big right now, they're an absolute fucking moron. Okay? You don't know, I don't know, nobody fucking knows what we're going to see in a couple weeks. But I know it's going to be a shitstorm, and I know that that means that risk is going to go through the roof. And instead of trading 15 contracts, 25 contracts, I'm trading one, just one, because I'm good. I'm real fucking good. But I'm no good in a market where they're just going to go in there and mop the floor with everybody. And I expect that. I expect them to do that. Okay. So there is a perfect stage being presented over the next couple of weeks where the level of manual intervention is going to be astronomical. I hope I'm wrong. I hope I'm wrong. And I hope it's smooth trading and just lots of really good low resistance liquidity run and less high resistance liquidity run conditions. I want that. I do want that. But it would be disingenuous of me as a quote unquote educator and mentor with your well being in my mind and aim for me not to remind you that you should dial back your risk. What happens? Okay. What happens if you make a lot of money and you're over leveraged? You're not going to stop there. You're going to take another trade, do the same thing, and you may not get the same results. And it may be worse, and it may end you. You may not be able to, to refund or purchase new accounts. You may not be able to do that, or you get scared because you've done that. Contrast that with listening to the old man, okay? If you just take one contract or trade in micros, this is not a once in a lifetime opportunity. It's going to seem like that, and everybody's going to sell it like that because they're gambling. When everybody's flying to Las Vegas and they're thinking, I'm going to take this couple $1,000 and it's a once in a lifetime chance. I feel like I'm lucky this time. And I'm gonna make $100,000. I'm going to pick the right slot machine. I'm going to play blackjack and backgammon. And there it is. The roulette's going to bless me. I'm going to go home with six figures. I just know it. And you're driving home or flying home, busted, disgusted, and just pissed off you never even went there. It's easy to sell your ideas to yourself and think, what if it does this in my favor? I'm just trying to be a voice of reason, and you can hate me for it. I don't care. Laugh at me if it's easy trading. I don't care. You don't know it's going to be like that. So risking with big leverage over the next couple of weeks, I honestly until the end of the year. If you're trading with, elevated leverage, you're a gambler. And I don't give a fuck who you are, where you came from, how much money you made, how long you've been doing it. If you're pushing leverage in this environment, you're an absolute definition of a fucking loser gambler. And if you make money, I'm not impressed by that. I am not impressed by that. There's a lot of people that win the fucking lottery that had no skill. There's a lot of people that went to that casino and there was no skill in them doing that. Now, poker, I'll admit that takes a little bit of skill. But pulling a fucking slot machine down, there's no skill. None. Pushing a button and waiting for things to spin around, there's no skill in that. But everybody that comes into the marketplace and they think they're just going to over leverage and get these big, big moves and not have any hardship coming up in the next couple of weeks, just listen to me, okay? Your career is not encapsulated in the next couple of weeks, but you can end it in the next couple of weeks. I'm not saying you'll never make more money to put into another account or afford to pay for funded accounts, but you're going to end the visibility of what you believe in yourself by wrecking yourself. The lasting impressions of damage that's caused by over leveraging and conditions that we're about to experience, you can't fully appreciate that. I have lots of that stuff from the 90s in me still. And you don't have the 30 years experience that I have. So how do you think it's going to affect you as a new trader or a relatively new trader? It's going to be much more impactful. Adversely, it's not going to help you. It's going to make it harder for you to execute because you're going to be now thinking about fear when fear shouldn't be any factor in your trading. Respect the risk, but not fear it. So have yourself a very pleasant weekend. Be safe. And Lord willing, I'll be back again on Monday. If you found this insightful, if you learned something from this, give the live stream a thumbs up. I promise it doesn't make me any more money. It just lets me know that you received something that helped you. And that's all it really means to me. If or not, it doesn't matter. I'm still going to make more videos. Until I talk to you then, be safe.